So let's pivot to one of the biggest problems, one of the biggest challenges I face with my clients is oftentimes they come to me, they've started learning about this stuff, they started doing infinite banking, they started doing velocity banking, or they're interested in doing it. And they say, hey, now the more I learn, the more I'm questioning the $500,000 I have in a retirement account. Maybe it's a 401k, maybe it's an IRA, maybe it's a Roth, maybe it's a combination of those two. And they're saying, you know what? I don't like having all that money at risk. It's not really doing as much for me as it could in other cases because it's really just doing one thing for me, and that's hopefully growing, and that's it. That's
Mhm.
all it's doing for me. And I really value liquidity, access, and control, and I have none of those things here. Can I get it out of jail? Is there anything I can do? And my response is always, you can get it out of jail, but the piper's going to have to be paid one way or another. We can strategize different ways to try and do it, but there's always going to be, some cost. The ransom is going to need to be paid to the jailer. But I think, Sebastian, you maybe have a couple of strategies about how people could potentially try to best optimize money they have in a retirement account where maybe they're not sure they want it there anymore.
Yes, sir. So this is going to be applicable to anyone who is a business owner or is willing to start a business. And is with this strategy, you're able to roll over a qualified retirement plan. It cannot be a Roth. It can only it cannot only pre-tax retirement funds can be used. Okay. So an IRA, a SEP, a 401k, a 403b, a 457 TSP, a pension, all of these things can be used. Um, and ultimately, you can roll that over into a new 401k. Your business will be structured as a C Corp. You can set that up yourself. If you have an existing business, it has to be changed to a C Corp. And what you're doing is you're self-directing the investment into your own company. So inside of a 401k is a very conservative long-term investment portfolio where you're basically buying shares and stocks of other companies. That those investment dollars land in those companies' bank accounts for them to use in their companies. And when their companies, those companies in your portfolio, when they perform and they do well, then so does your 401k. So what we're talking about doing here is instead of investing in other companies, you're self-investing. You're directing the investment into your own company and purchasing your own shares through your C Corp. So if you have 500,000 in a 401k, well, that's 500,000 that will now land in your business's checking account, tax-free, penalty-free, debt-free.
Mm.
Now, there are some rules that you have to follow for this to work. Well, first, there's a cost. It's going to cost it about 5,000 to set it up. So the minimum rollover is going to be around 50,000. That's one. Number two, the 401k or the qualified retirement plan cannot be attached to a custodian who's controlling the plan. So if it's attached to an employer who's controlling it, they won't release it. You can't use it. Number two. Next, the business itself to qualify has to be a legitimate business, not just a shell. Meaning, you have to be able to show that that business has expenses going out and income coming in. Next, you have to pay yourself on payroll at least once a year. And finally, you have to report the business and the structure to the IRS on a monthly basis, which is separate from your regular business tax filings that you do. So there's an ongoing monthly cost, which is around 100 to 150 for that monthly reporting to the IRS. So this is a way that you can leverage a 401k or IRA. And now it's in the business, and now you can use it for your business. And one of the things you can do as a business owner is you can purchase what's called key person insurance, which is going to be a whole life insurance strategy, what I would call your business banking system. And from there, you can start practicing infinite banking in your business. Now, with that revenue in your business, you can also put yourself on payroll, and that's going to be income. With that income, you can now purchase your lifestyle banking system for your personal use, not just for the business. So this is one way that we can leverage a self-directed 401k to access pre-taxed dollars, retirement funds on a qualified retirement plan without penalty, without taxes, and it's not debt. We don't have to pay it back.
Wow, that's phenomenal. There's so many things I'd like to discuss there. I don't want to go down too deep of a rabbit hole, but I do just want to mention, key person insurance. That's basically saying if you're a business owner, maybe I have one guy who's a rainmaker, and I know that if something happens to him, I could be in trouble. So I want to protect him by taking out a life insurance policy on him, right? If you're a business owner, there are multiple different use cases for life insurance. Another would be maybe a buy-sell agreement. So if you have a business partner, what happens if one of the two business partners dies, right? That's
Right.
what a buy-sell agreement would cover. And there are multiple others as too. Those are kind of two of the most common in a business scenario. I do want to mention also, it's not as robust of a solution as what Sebastian just laid out. But there are other options for people who maybe are not business owners, or maybe they have it in a Roth or what have you, where it won't be there will be costs associated with it. Like always, there's no free lunch. The piper's going to have to be paid. But as an example, if you have money in a retirement account, you can do something known as a 72T transfer, where basically you're moving your money from your retirement account to a whole life insurance policy. And if it is not a Roth, you will not avoid paying taxes. So you will pay taxes on it. The way I view that is you were going to pay taxes on it anyway, just a matter of when. Um, but you will avoid the 10% penalty. And there are rules around it. You can't just pull out as much as you want whenever you want. There's a certain schedule you have to follow of when you can do it. But that's another example of a potential solution if you have money in a retirement account and you're not sure you want it there anymore. And believe it or not, Sebastian, I do have clients who are just like, you know what? It's worth it, right? The opportunity cost, like we keep discussing, the opportunity cost of waiting like 3, 4, 5 years to start your whole life insurance policy is pretty large.
Mhm.
And yeah, the taxes and penalties you might pay on cashing it out, they can be significant,
Yep.
no question about it. And everybody's got to make their own decisions. I'm not giving investment advice, but it's something I've done myself where I just cashed it out. I had a 401k from a previous employer. I just cashed it out, paid the taxes and penalties. And I have people who do that. In fact, I was talking with Chris Kirkpatrick, and he was saying, look, this is not the same for everyone, but if I had $1 million in a retirement account, I would cash it out and take the taxes and penalties because the opportunity cost for me being a successful business owner, real estate investor is huge. And I know if I have 500,000 or 600,000 in my pocket today, I can grow that dramatically more over the
Right.
next years, right?
Yeah. So I think that one of the reasons someone would say no to it is because they're thinking about trading one um, retirement plan, which they can't really use or have any access to, for something else that they're comparing it as the same thing. And the difference is that if you keep it in the 401k or in the qualified retirement plan, it's only doing one thing. And you are not avoiding taxes, you're just pushing that burden down the road, which chances are you're going to pay a much higher tax rate in the future because tax rates never go down, they always increase. So when we move it into a whole life, into your infinite banking plan, now you can use it at the same time. And that's the difference. It's not just how's the policy going to perform. And even if we just looked at the performance of the policy on the compound interest, you'll see the growth, and you can compare that to how your 401k or your other retirement plan may perform, and see if that just by itself makes sense. But the key is that what are you going to do with the money now that you have access to it? Can you invest it in real estate assets? Can you invest it in Bitcoin? Can you invest it in the stock market or in precious metals? These are some different places that you can put your money to realize gains that will multiply that growth way beyond what it's going to perform just sitting in a qualified retirement plan. So
Yep.
that's the difference in someone who thinks like Chris Kirkpatrick versus if we're just thinking about letting it sit there and we're not going to do anything with it. And again, that's the key, is that we can do multiple things with our money at the same time, still have it protected, and still have it growing compound interest inside the policy.
Yeah, once again, what is seen versus what is unseen.
Right.
We could do a whole episode. One of the things I find very frustrating is how people who don't understand infinite banking and don't understand whole life insurance just obsess over the numbers on the page. And they're just myopically focused on what's my cash value, what's my cash value, what's my cash value, what's my cash value. Oh, it's only growing at what, 4%? Okay, yeah, I don't want that. Missing this huge, bigger picture. To me, that's like looking at a piece of amazing cash flowing real estate and just saying, what's the total value of the property and how is that going to grow over time? And maybe it's only growing at 4% per year. But capital appreciation is only one of many, many, many benefits you get from owning cash flowing real estate, right? Likewise, if you look at a cash value life insurance policy and all you're looking at is the cash value growth over time, you're missing a huge piece of the picture, right?
Yep.
So what is not seen is the opportunity cost. What is not seen is, hey, I can use the money that's in my policy without interrupting that growth.
Yep.
It's not a single use vehicle. If money's in a 401k, that's a single use vehicle, right? I can't use it and have it keep growing at the same time. What about the death benefit? That's another thing that they completely ignore, right? This is a self-completing plan, right? So if I put money into a life insurance policy with the goal of saving $1 million and I drop dead tomorrow, the life insurance company completes my plan because now that death benefit pays out. If you start saving money in a retirement account and you drop dead tomorrow, now your plan's done. It failed. You
Yep.
didn't do it,
Yep.
right? It's over, right? Not to mention long-term care protection,
Mhm.
right? I know a lot of people who have seen parents, grandparents, in-laws go through end-of-life issues where they spent significant sums of money. The death benefit can be used for that. It protects you against that. In some cases, even a critical illness like heart attack, stroke, cancer, right?
Yep.
What about the tax benefits, right? This growth is tax-free, whereas growth elsewhere in a lot of other accounts will be taxable, right?
Yep.
Uh, what about the control aspect, right? I mean, so many different things.
So many
And of
different.
course,
I
when
think
they
when
show the
if you look at this
projection,
holistically, with all the right information, then it's a no-brainer. The problem is that there's just unfortunately so much misinformation, and even people in our space that are misrepresenting how this is to be used, that a lot of people are just, you know, afraid, and they're paralyzed of making good conscious decisions because they don't know what's the truth. They're not sure what to believe and who's right or who's wrong. And then they speak to a financial advisor who tells them buy term and invest the rest. And so they don't know who to believe. So um at the end of the
yeah,
day
I
though,
don't
I
I don't know
think
if you saw my financial malpractice series, but it is astonishing the level of, I don't know if it's ignorance, I don't know if it's misinformation, but a whole email full of just the most obvious third grade level fallacies about whole life insurance, just making errors that should be embarrassing. I mean, it should be embarrassing that anyone with a securities license would believe or say these things. And yet,
that's what
I
they're
guess
saying.
they're accepted. I don't know.
Yeah. That's unfortunate, but that's our job, and this is what we're doing, and hopefully, videos like this and these conversations go viral, so that more people can get educated and learn, the truth about it, and can start seeing things differently and have a paradigm shift. Because if you're not doing this, you are missing out on a huge opportunity. So definitely,
Is is there anything else you would leave people with in terms of retirement accounts? Because I know there can be a lot of different ways. Like you can even own whole life insurance inside of a retirement account. I don't know. I don't think that's always the ideal way to do it.
right.
But if someone just generically, we won't give any specifications, but they have money in a retirement account, maybe for whatever reason, they're not a candidate for that great, very robust strategy you laid out. Are there any other things that people should think about that should consider that maybe might help them?
I mean, you could always roll over a retirement plan into a different plan. So like for your 401k, it could be rolled over into an early qualified retirement plan where you could purchase precious metals, and you could avoid the because these were other retirement plans are actually still considered retirement plans where a whole life policy is not. So therefore, if it's precious metals, if it's real estate, there are qualified retirement plans that you can roll your money into, um, with without paying the taxes or penalties or fees, but it's still in a retirement plan.
Mhm.
Um, and so once it's in there, you can typically borrow up to 50% of it, not 50%, $50,000 on that,
Mhm.
without, some of the penalties in these unique plans. And so there are some other ways to get, but it's not going to give you full access to all of your money. And you're moving it into maybe a better performing vehicle, maybe rather than a 401k, you'd rather have it performing in real estate or in precious
Yeah.
metals or in even cryptocurrency. So these are some different places you could move. You can also roll it into an annuity, which is in my opinion, probably the best thing you can do for guaranteed retirement income. But that only makes sense when you're in your later years,
Right.
probably at
Right.
least 55, in that right around there is the
Mhm.
time you want to put it into an annuity. Um, but even if you're a little younger, you could put it into a growth annuity. And then once maybe for 7 years, just realize the growth where you're not going to get any income out of it. And then from the growth annuity, roll it into a guaranteed income annuity once you reach around 65, between 65 or older. Um, but with a guaranteed income annuity, I mean, you can guarantee yourself income for the rest of your life. And that's, basically you creating your own pension. So that's another great use of a retirement plan.
Yeah. Yeah. Well, a topic for another time, but it's not about building the nest egg. It's about building income, right? How much income can you realize? And that's where an annuity can come in, where you can convert a nest egg into an income stream. Because as you age and reach retirement, you realize it's not so much about the size of your nest egg, because you don't know how long that's going to last. It's more about how much income are you able to realize, whether it's from that nest egg or from somewhere else. The nest egg by itself, it's a great thing to have, but it doesn't do anything for you by itself. It's a matter of how much income can I get out of it? How long can I stretch it out?
Right.
And the answer is we don't know. With an annuity, now you have a guarantee that that income will not run out.
Yep.
So, Sebastian Boyer, thanks so much for your time. We greatly appreciate it talking to us about infinite velocity, his own term, and also talking to us about some potential creative solutions about retirement accounts. Thanks so much for your time, Sebastian, as always.
Thank you, Logan. My pleasure. Take care.